The SharePickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
And joining me on the podcast and on video, Russ Mould Investment Director at Stockbroker AJ Bell. You all right, Russ?
Yeah, well, I'm getting hot and bothered. My glasses are steaming up. It's that warm outside. So here in sunny Brighton, so it's possibly uncanny.
Yeah, no, it's a quick brisk walk with the dog, and I was actually breaking a sweat in a t-shirt.
Yeah, there you go. It's good.
Unbelievable.
No,
and the market seems to be warming up as well.
Oh,
I mean,
they are. The unloved UK market, Still, the FTSE 100 keeps on going up, another all-time high.
Well, look at that. That there, above that line, pretty much, are all-time highs. So you got one, that didn't make it, 2, 3, 4, 5 all-time highs in the last week and a bit. So it's amazing. And not to be left out. I mean, the FTSE 250 is down a smidge, but it has rallied. But the AIM all share, this here is a
well,
previous...
you called that last week, mate, looking at the DMAs and everything. You called that last week, so...
Yeah, what's nice about this is if you look at this previous high, of course, there's massively oversold position from October lows. That seems like the low now. And it rallied... You very rarely get a chart go straight up. Nearly did, though. When that happens... It's V-shaped recoveries are not really sustainable, and it has to have a pullback and a breather. And if you look at the sort of relative strength index on, you can see here it really went over the 70 level and got a bit overcooked, and so it had to come sideways. But now this high, it's not even at 70, so there's plenty of steam left in it. So I think it can still go a bit further and break that previous high. So it's looking very good.
I defer you technical types. But this looks interesting to me, I have to say. And again, as a willful contrarian, I'm always interested in things that have done and people are still kicking when they're allegedly down, but actually they're up. So just think what happens when they change their minds.
Exactly.
You know,
and
it's the old thing, right? The stock market is about getting to people to agree with your points of view later.
Exactly. And there's lots of opinion on stock shares, markets, macro. In fact, not a lot of opinion here, hopefully, but the shop index, retail index prices have gone down. I mean, they haven't gone down. I've got to say, I do listen to lots of financial podcasts, and I've heard some people saying prices are going down. No, they're not going down. And in fact, when I listen to
decelerating. The rate of increase is slowing.
That's it. In fact, one you put on quite a lot that I really enjoy, saying, prices have gone down. They haven't gone down. I mean, so here, it's 1.3 last month, and now it's only increased by 0.8 this month, which means, the inflation's slowing down, which is a good sign as well. The Bank of England will keep
I think with, in fairness, in that the non-food reading was actually down year on year.
Oh, was it?
It was actually minus 0.6% year on year on non-food, which they put down to discounting, particularly in things like the supermarket. So that's kind of an interesting one. So that is a little bit of good news for consumers and maybe even for the benighted bank.
Yeah. Well, do you know what? It's quite interesting as well, talking about banking sector and all this stuff, but the mortgage rates have been edging up a little bit. So they came down in the expectation that the Bank of England will reduce, and it's been pushed out. And now a couple of mortgage providers have been pushing them back up. And I'm thinking they're doing that old trick with the old sales ploy, where you increase your price a little bit before sales happen, and then you can say, rather than this 30% drop, they say it's a 50% drop. So, but it's looking quite bullish. Even with that, mortgage lending's gone up in March with our mortgage approvals for 63,000. So it's up from last month, and net lending to individuals 1.8 billion. I mean, it's up from forecast 1.7, down from previously, but it's warming up a little bit. It seems like
it's interesting. I mean, that mortgage approvals figure's way up from sort of 30,000 low when Liz Truss was working her magic for 45 days, whatever it was, and it is an encouraging sign. I mean, as you say, the banks are. I think the banks are under scrutiny for what they're doing with their net interest margin, so they have to be careful. They have in the first quarter results shown some sort of stabilization, with the exception of Lloyd's, intriguingly. But I think also that increased mortgage rate will reflect the fact that interest rate cut expectations have been scaled back and gilt yields have gone up, so their cost of capital will have gone up a little bit as well. But I'm sure there's competition for deposits out there, so you do get the sense. Or to put it this way, analyst forecasts think that banks' profits aren't going to grow much in 2024 or 2025 in aggregate across the FTSE 100 Big Five. But intriguingly, fourth best performing sector in the FTSE 100 this year to date, banks.
Is it?
And
wow.
It is. And you know what? Nobody would give you the time of day for them a few months ago when they were trading at 0.6 times, 0.7 times book value.
Well, you called that. You kept saying there. I mean, you did say this. You've got to be worrying.
Wow,
is this
I'm very flattered that you remembered.
But it's always also you're saying they're very cheap. It's like, why are they so cheap? Sometimes that stokes suspicion and worry, and sometimes they're just cheap, and that's the opportunity.
And if things don't get worse, they might become a little bit less cheap. And I think that's what's happened with NatWest, with Lloyd's. I mean, HSBC, NatWest, and Lloyd's now all trade at 1 times book value. Barclays and Standard Chartered trade at 0.6 times book. So maybe they're the ones, if you're a willful contrarian, they're the ones you'd look at. Why are they trading so cheap? Well, nobody trusts Barclays investment bank business. And at the moment, Standard Chartered, a bit like HSBC, is getting the sort of tarred with the China, Asia, emerging markets brush. So I think they're the reasons why. So if you think that UK equity market's about to get buoyant, Barclays is probably a leverage play on that. And if you think that China's ever going to come back, and you kind of have to think it might do, then Standard Chartered might be a way of looking at that. But again, things that were out of favour, as we've discussed many times before, that, you can have cheap stocks and good news, just not both at the same time. All right, you can argue the Mag 7 might be an exception to that right now. But generally speaking, if you want the cheap stuff, you have to hold your nose, do your research, and find the stuff that's cheap. So what's done well this year? Okay, with 350, the best performing sectors, I'm looking at my cheat sheet here. Telecom equipment is best. That's because of a bid for Spirent. Aerospace and defence. Okay, I get it. There are 2 wars going on at the moment, so you understand that. Pharmaceuticals. A lot of that's Glaxo, which again is a cheap, unloved stock. Then banks, and then oil and gas producers. Again, I guess that's maybe related to the Middle Eastern war, but there's some stuff in there that you wouldn't necessarily have picked up. So what are the duffers? What's doing badly now?
Well, that's it. That's the thing.
So there you go. That's the next question, right? So what are the duffers now?
Look at Barclays there. Barclays up 60% in the last 184 days. That's
and nobody's asked me a question about Barclays ever during that period.
Yeah, exactly. And so people are now jumping on the banks, and that will powers the rise a bit higher, but it gets frothy then towards the top, because when people jumping on, missing out. But yeah, exactly. So when we were talking about banks being cheap a while back, no one was interested. So what are the sectors now that are cheap that no one's interested in?
So the duffers now are personal goods, which is Reckitt, Benckiser and Burberry. Okay. Yeah. Automotive and parts, which is a pretty teeny sector. It's probably Smith's Group, or something like that. I would think. I'd have to check, frankly. TI Fluid Systems and things. Life insurance has been a dog this year. I think that's probably down to Prudential, because again, it's China. It's a very ex-Asia play now because it got rid of Jackson Financial in the US. It spun off M&G. That'll be being again feathered because of its exposure.
Which one was that? You said? Which
Prudential.
One? Oh, Prudential.
The man from the Pru, that'll be being tarred by its China exposure. Electricity, I'm guessing that's a pre-election wobble and regulatory wobble. And then real estate investment trust, surprise, surprise. Is anybody going back to the office and is on a permanent basis and is, online retail killing bricks and mortar retail? So they're the ones that at the moment you think, well, if I'm a real contrarian, you maybe look at chemicals is down there as well. That's, Croda and Elementis have kicked out Croda under pressure from an active investor. So they're the ones where maybe you can do it. And Elementis has been subject to 2 bids in the last 4 years. So somebody's looking. So again, this is not advice, but if you're looking for what's going to be the next ones to turn, maybe they're the ones that are worth a nose. Though I know a good friend who is a chartist says, when something breaks through an all-time high and the charts, the DMAs are still going up, he's always very reluctant to fight those charts, I have to say, which is what you've been saying.
Well, look at that. I mean, Prudential. I mean, I don't look. I mean, I don't. That's the wrong one. I don't look at big stocks too much. But I mean,
it's a FTSE only company. Look at that chart. Now that is so ugly, even a mother wouldn't want to feed it. I mean, that really is pretty terrible. So
exactly. I mean, you should never fight a trend. I mean, and that there's look at that. That's a 200-day moving average. It hasn't touched that. It hasn't met with that since July 2023. It's been strangers, and it's still nowhere near it. So I mean, I would be looking at, say, a break of at least a 50-day moving average, and then I'd also look at who pays the best dividend, because I'm going to sit and hold it for a while. Maybe I'll collect
Legal & General in the life insurance. Legal & General is a big meaty dividend payer.
That's right. Yeah, LG. Yeah, so in fact, that's not too bad.
That's not too bad, that one, I don't think. I mean, Pru, there's a relatively new chief executive in, and he's talking about there's a big strategic review going on. There's a new capital allocation policy going to be revealed at some stage this year. So I guess now everybody's probably holding fire until they see that, I would think.
Yeah, I mean, there's a 50-day. It's broken that, but you can have some fake breaks. It's an early indicator, but then it may signify the bottom of break down further. But look, it's not. I'd say once it's broken that 200-day moving average, it's going to rise, because it's not done that since July 2023, and so that would signify a change in the momentum there. But that's very interesting. So these big stocks, but like I said, the banks. I didn't realize Barclays had rallied so much.
That's the uncanny thing about these. Again, that's how cheap stock can really surprise you. If you're confident it's not going to go bust, the model's not broken.
Yeah.
Then sometimes you just have to be very, very brave and very patient. And it's the old thing. You said it last week. When things are really cheap, you should buy, but you sure as heck don't feel like it because you think, well, what am I missing? What? Yeah, and that's why you need to get your hands dirty and do your research.
I heard today that HSBC CEO is off. He's been there 5 years.
That's correct. He's retiring, so he's been in 4.5 years. Yeah. The shares have actually underperformed the FTSE 100 over that period. And I guess that's probably because, again, China had a 3-year lockdown, and Hong Kong is, there is still suspicion as to whether Hong Kong will ever be the same again. And I know that the words it's different this time are generally quite expensive, but you can't see Hong Kong being the freewheeling mercantile area that it was under British control, I'm afraid to say. And so, but even that market's having a go now because the Chinese are trying to put some stimulus in place. Yeah. So HSBC, I think, has been, again, another, seen as another China loser, as it were, along with, Prudential and Standard Chartered. It's just paid a special dividend. It's trading at about 1 times book, which probably feels about right-ish. But again, if China really gets going, then I would think that 1 times book value would become a floor for the valuation, not a cap as it's been recently.
Yeah, and isn't about 70% of their business now is Far East? Is that
correct? Right? Yeah, he was obviously originally the Hong Kong and Shanghai Banking Corporation anyway. Yeah. And that is still well over half the profits of the business. And they've just sold Canada. They've just sold the French retail business. That focus is only becoming more acute, I would suspect. Yeah.
Well, do you know what? When I'm looking at talking about underperforming, when I'm looking at stocks, I tend to put them in 2 buckets. One is a performer, and one is a recovery. And to performers, you have to pay up a little bit more for them. But you hopefully, because they're great businesses, they'll continue to perform. You get a nice return. But if you want a bit more risk, then recoveries, because they can have like I said, if you look at Barclays and all that, they can as long as it's risky because. Is the recovery on? You don't know, and normally they are. If it's just the sector is in the doldrums, that's a good sign. It's not business specific, and so, like I said, that's a recovery. Look at that. That's unbelievable. Yeah. In fact, since pretty much since February.
And what I would say is, if you are, if you're trying to cut down on the amount of research that you do, and let's face it, there's a lot to do. Yeah. A bad stock in a good sector will generally outperform a good stock in a bad sector, and that's and what do we mean by a bad sector? Well, it just could be cyclically depressed. It just could be a bad time, or it could be one that's the model's broken. Think newspaper publishing 5 or 10 years ago. So again, you've got to work out which is which. But generally speaking, if you find the right sector with the right fundamentals behind it, that will cut down a lot of the research. And even if you don't get the one that performs the best within it, you'll probably still do better. Again, if the market's pricing in strong earnings growth and strong upturn, a Duff steel stock or a Duff cyclical stock will probably still outperform a really well-run pharmaceutical or healthcare company, for example, at that stage of the economic and market cycle.
I'm going to use that for the title of this podcast and video. So you're saying, say again, Russ.
A bad stock in a good sector will generally outperform a good stock in a bad sector.
Marvellous stuff. We'll leave it there. Russ, thanks for that, and speak soon.
Take care.
The SharePickers Weekend Podcast with Justin, Paddy, Peter and Steve. The content of this podcast is not intended as investment advice. It is for information purposes only. People in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.